5% NPL ratio, it's kind of difficult to believe that every bank that guides to less than 5% NPL ratio can be taken in the same light as GT or Zenith, just because the historical trends do not support that. Now, the CBN have a view that they don't want banks to be reporting NPL ratios over 5%. So you could argue that maybe that's why banks are trying not to get a call from the CBN to explain to them why the NPL ratio is over 5%. So what we've tended to do is to assume that if you've not shown this trend historically, then we're not going to give you the benefit of the doubt. So if you look on the table on the left, you find that the guidance generally is below 5%, but we expect that these ratios will get worse. However, we don't expect anywhere close to 10% for the sector average by the end of this year. I put the table on the right to point out that there is a big difference between a tier 1 bank and a tier 2 bank in terms of asset quality and the way banks have decided to run their operations. So if you look at Zenith, which I've talked about a bit, in terms of asset quality, Zenith is one of the best in this country. Concentration risk is really what I'm trying to show on the table on the right. So for both banks, you see a worsening in 6 months in terms of the top 5 sectors, what those account for in their loan books. So for Zenith, it was about 50% in December. It's gone up to almost 60% as of June. For Diamond, the top 5 sectors represented 73% in December, and as of June was 78%. So just based on the numbers, no one is saying that these books are going to go bad, but just based on concentration risk alone, again, the likes of the Zeniths are set up better than a Diamond Bank. Where this takes us is that generally, if you look at banks in Nigeria, they tend to report ROEs of below 15% or above 20%. The 15 to 20% range is extremely unstable. So that's where you tend to find mispricings. So if you listen to several tier 2 banks, they'll tell you that, oh, we'll get to 20%. We've been hearing this for the last, God knows how many years, 7 years. It's been extremely difficult to do over 15% for these banks. So whenever you hear a tier 2 bank tell you they're going to do 15 or 20%, just discount it or ask them a lot of questions because the evidence doesn't support that. The bigger banks tend to be able to kind of get away with that. Now, if you find a bank that you should expect to be above 20% in the 15 to 20% range, there's likely to be a sort of mispricing. Either the market is waiting for that bank to recover, or it is punishing the bank because of some historical reasons. Sometimes you find the likes of a UBA in that category. So this gulf, we think, will open up even more going forward based on all the lines in the P&L that I've just gone through in the previous slides. So we expect the divergence between the larger and the smaller banks. Now, what you find in terms of valuation is that the tier 2 banks are trading well below book. We don't believe this is justified. However, until there is evidence that the tier 2 banks can show some improvement that's borderline sustainable, I think the market will just continue to say, you know what, I couldn't care less. When you have something interesting to report to the market, we will pay attention. For now, we'll just stick to the guys that we know that the results may be boring, aka GT this week. The numbers weren't amazing, but actually you know roughly that they were going to do 120 billion this year. They said that at the start of this year. So they're on track to achieve that. The tier 2 banks have to consistently deliver results that people can believe. So you may report very good numbers in Q1, but by Q4, let's see whether your provisions line don't blow up. To move on to the non-financials, I'm focusing purely on consumer goods here because I think it's topical and you hear more from some of the panel discussions later today. The price to earning multiples for this space has generally moved down over the last few years. That's not to say that the 23.6 times P multiple you find there is actually justifiable. It's still way too high. We can argue that those numbers should be lower because of what's happened to the earnings. If you look at the H1 pre-tax profits, generally you see a worrying weakness, and this has been consistent for some years. We had Nestle's results last night. It was a breath of fresh air. For the first time, there were some relatively decent results. DSR also reported relatively okay numbers, but by and large, across the space, it's been very, very challenging. You'd expect that with the decline in raw material prices, given that we import quite a lot of stuff, including raw materials, that this will actually positively impact earnings in this country for these companies. But what you find is that there are other issues that they have to deal with. For example, FX devaluation, insecurity in the north, messed up the distribution network. And then competition is really beginning to cause problems for some of the non-food companies particularly. right? Because, whether you're Nigerian or not Nigerian, you care more about what you put inside your body. But if you're really pressed for, if your household wallet is really squeezed, then you may experiment with other things, right? So if you're in the food category, you may get away with it. If you're in the non-food category, you really have to work out to sustain your market share.